share. All right, students. So now next is in the chapter that is we are covering chapter number 30, accounting fundamentals. We'll talk about final accounts of a business. Huh? So final accounts, we know that why they're called final accounts because they are actually developed at the end of the financial year. That is the reason we call them final accounts, and they are also called published accounts as well. Why? Because they have to be published in the newspaper as well. Okay, and it actually shows the important figures related to the performance of the business, related to the financial strength of the business. Okay, and it is actually useful for many people. We discussed that in the previous class as well, that why people um, like what kind of people will make use of those accounts, and what are accounts, and what is the importance of it. Other we have already done it. Now we'll talk about final accounts. Okay, let me admit a few of more students. Shahzeb, Khalid, and okay, all right. Okay, so we'll talk about like first is income statement. Income statement basically shows the profit of the business, right? By comparing revenue with the expenses of the business, right? And you know that this is the way we calculate profit. Like we subtract revenue, subtract all our costs from our revenue, so we get profit, right? So when I say all costs, it means fixed costs and variable costs as well. So income statement shows that is important. Then balance sheet again. And now the new name for balance sheet is statement of financial position. Huh? I told you earlier, I guess, as well. And that basically shows the items which are owned by the business, and we call them assets. Like think about land, building, equipment, machinery. So these, even inventory which you keep as a raw material or work in progress or finished goods. And we have talked about inventory as well. So all the items which are owned by the business, they are called assets, and we discussed earlier as well, and they are shown in the balance sheet at the end of the financial year at a given date at a certain point of time, right? Similarly, it shows the liabilities of the business as well, and liabilities are the items which are owed by the business. Like business has to pay it back. Like think about bank term loan, long term bank loan. It can be debentures as well. Um, Similarly, if you have bought goods on credit, so there will be another item, we call them creditors, but now the new name is trade payable. So that will also be your liability because you have to pay it back. So that will be shown there, and then business will be able to know about its financial strength. Why? Because they can see how many assets they have and how many liabilities they have to pay. So they can compare it, their assets with the liabilities, to see the financial strength of the business as well. And it is also important for many people who actually want to make use of the final accounts, be it your customer, be it the government, suppliers, bank, even your competitors, the workers, managers. So we discussed that earlier as well, that it is important for them to see it. Then cash flow statement is also there. So we actually drew the cash flow forecast as in the earlier chapter. So cash flow basically keeps a record of how much cash is coming into the country and how much cash is going out of the country. And you know that how important it is to have a record of the cash, because at the end of each month you need to know whether you have sufficient amount of cash available or not. If it is not, you have to make arrangements according to it now. So, and if it is surplus cash available, you can use it somewhere else for the benefit of the business, right? So the cash flow is again have actually has the same importance as other accounts like income statement and balance sheet as well. In fact, sometimes it is more important. I told you that sometimes if you do not have ready cash, so you cannot actually run your business at all, even for one day. But without profit, you can survive if you have ready cash available even for a few months as well. Huh? So we discussed that. Okay, now so profit and loss account. I am just the word is there because that is the old name given to income statement. Now the word is income statement, but it is also called profit and loss account because earlier That was a name which was actually used for the uh, for the income statement, right? Now it records, I told you earlier, revenue, cost, and profit of a business over a given period of time, usually a year. Normally, after the end of the year, they actually show how much cost actually incurred by the business over the course of the whole year, and again how much revenue was generated and the profit earned by the business as well. This is shown in the income statement, and a detailed profit and loss account actually is drawn up for managers. Why? Because manager has to see what is happening, because they have to play with those figures. Like, you have to see that, okay, if there is a cost there, so whether it is increasing or going down, how to reduce it, or which cost is actually more significant in to control. Why? Because, like, let's say if you have higher fixed cost and lower variable cost, so you need to control your fixed cost. Similarly, if your variable cost is, like, your labor cost is greater, has a greater proportion of your total cost, okay, so, or comprises a greater proportion of your total cost, so then you have to control your labor cost as well by not increasing the wages or by reducing the number of workers. So you can do something for that, but for that, what is required, detailed information should be provided to the managers. So for that, detailed profit and loss account is made, but that is only for managers. This is not published, I'm telling you, because the profit and loss account which is published, that is not in that detail. So we call it management accounting. So you need to understand that information which is provided to the accounts, and accounts which are made only for the manager so that they can take the scenes effectively, that is what we call management accounting, and they actually are in very much detail, because managers have to find out the root cause of the problems and have to take necessary actions, right? Whereas a less detailed summary, now it's written summary, huh? So it might contain only the final figures of the items. Huh? So less detailed summary appears in published accounts, and we call it financial accounting. So accounting which you study in A levels or in O levels as well, or you might study in high level classes. So that will be financial accounting, right? So, and you see a less detailed summary over there as well. Whereas management accounting is actually studied by those people who actually go for the degree. That is what we call cost and management accounting, right? Even CA, if I talk about chartered accountants, they also study financial accounting, right? So again, you know need to know the difference only. What is the difference between management accounting and financial accounting? That's it. So the published accounts which are published, they uh, they are actually based on financial accounting, right? That is less detailed summary of it. Okay. Then okay. Now if we see the different sections of income statement, so the first section we call it trading count. Okay. And what is obtained from it? We get gross profit from it. And what is gross profit? That is the figure we obtain by subtracting cost of goods sold from our revenue. Now, the new name for sales revenue is revenue. So you can use the word revenue as well. Similarly, for the new name for cost of goods sold is cost of sales, right? So you can use that as well. So if we subtract cost of sales from our sales revenue or revenue, we get gross profit, right? This is the first part of the income statement, and we call it trading count. Now, in order to, revenue is normally given, right? Okay. So if revenue is not given, still you can calculate revenue. Na? Revenue is calculated by, I told you earlier while drawing break-even chart as well, price into quantity sold. Whatever item you sell, if you multiply it with the price of each item, you will get revenue. So it's simple, but generally, or most of the time, sales revenue or revenue is given to you in the question. Whereas cost of sales is sometimes given, sometimes it is not given, and you have to calculate it. So it's very simple because it's not that complicated as it is there in accounting. Those who study accounting, they know about it. So I'm just using a simple formula for calculating cost of sales, and that is opening stock plus purchases minus closing stock. Now stock is again the new name for the stock is inventory. Yeah, you know that because we did study that at that inventory management chapter. So what do you do? Opening stock is the inventory which you are actually taking from the previous year. That last year maybe there was some stock which was left unsold, whether in the form of raw material, work in progress, or finished goods. So you keep it the opening inventory of the next year, right? Like you say that this is the stock we have right now at the start of the year. So at the start of the year, whatever stock you have, which you actually purchased previous year, and that was the closing stock of the previous year. Now it becomes automatically the opening inventory of the next year, that it already is with the business at the start of the year. And then obviously you purchase some items as well for further production, because that opening inventory or stock will not remain there. It will be consumed sooner or later, if business is producing and expanding, or let's say start their production from the start of the year. So you might have to purchase something during the year as well. So purchases are there, you need to add it, and then you have to subtract closing inventory, right? Now this is important, because why do we need to subtract closing inventory? I told you closing inventory is the items which are left at the end of the year and they are unsold, right? So we why do we subtract it while calculating cost of sales? The reason is because cost of sales means that the cost or the amount which is spent on those items which are sold in the market. That is cost of sales or cost of goods sold. So the money which is spent on those items to produce those items which have been sold in the market, right? So closing stock is actually, or includes those items which are yet to be sold, which are unsold. So how can we add their cost? We cannot, right? So that's why we need to subtract their cost from the cost of sales, because this should not be added logically in calculating cost of sales now, because it is yet to be sold. That's why. So we that is actually the formula we use it in A levels business. Okay, so this is quite simple. I know that there are other items which can be added. A level accounting students, they know about it, but we do not actually consider that here, because here our focus is business rather than accounting. But still, because the portion of accounting is there, so you have to we need to study this chapter as well. Okay, so this is how we can calculate gross profit, and that actually is calculated in the first part of the income statement, that is trading account. Then comes profit and loss account, the second part of the income statement. And what do we get from here? We get net profit, or another name given to net profit is profit for the year. Now, net profit is the old name, and now Cambridge is using the new name, that is profit for the year. So what do? We actually subtract overhead expenses from the gross profit, right? This is how we do it. Um, because gross profit was actually is obtained from trading account, and then we carry it forward in the profit and loss account, and then we subtract overhead expenses. Now remember, so we get net profit, and this is actually the profit of the business, right? And I told you, we discussed in while drawing break-even chart as well, when we were actually covering that concept, that cost actually includes two types of cost, total cost. One is fixed cost, second is variable cost. Okay, so if we subtract all these costs, we get profit, right? Here, where is the fixed cost and where is the variable cost? I'll tell you. Like if you see cost of sales is a variable cost, I'm telling you, because it cost of sales increases with the number of items you produce, because you have to buy more raw material. So this is a variable cost, right? Similarly, when I talk about overhead expenses, so overhead expenses is a fixed cost. Like think about salary of the workers. You have to pay it, doesn't matter whether they produce more or less. Rent of the building, again you have to pay it, pay the rent of the building, doesn't matter whether you produce more or not, or even if you do not produce, you have to pay it. So that is a fixed cost. Similarly, interest on loan, like you have borrowed money from the bank and you have to pay a fixed amount of interest, a certain amount in the form of interest on a monthly basis or annual basis. Again, that is a fixed cost, because it has nothing to do with the level of output you produce, right? Similarly, depreciation, I told you earlier that you actually reduce a fixed amount from the value of your asset with the passage of time, because assets, they do lose their value with their use and with the passage of time as well. So depreciation is also a fixed cost. Doesn't matter whether you produce more or not. You actually subtract that fixed amount from the total value of the asset, right? Okay, fine. So overhead expenses, or expenses, the word expenses or the overhead, both are actually used for fixed costs. So it means that if we are able to subtract cost of sales and expenses from the profit we had, gross profit, or you can say, okay, another formula can be used for it as well. So we get net profit. One is this one, like you first calculate gross profit by subtracting cost of sales, that is variable cost, from the sales revenue, right? And then you subtract fixed cost, that is overhead expenses, from the gross profit to calculate net profit. So you can say that as well, that net profit is calculated by subtracting all costs, including fixed cost and variable cost, from the revenue. You can use that as well. This formula again. This is correct. Like if I write here that profit for the year can also be calculated this way, as I told you, that you write revenue and then you say minus cost, all cost. No? So it includes fixed cost and variable cost, right? So both costs be subtracted, like fixed cost is overall expenses I told you, and variable cost is the cost of sales, which is there, and it is always there in the trading account where we calculate gross profit, right? So you can use this formula as well. There is no harm in it. So this is also possible, but again, the other one can also be used for that. All right. So moving backwards. Um, Okay, so we have talked about the second section of the income statement as well, that is profit and loss account. We get net profit from it. Then comes appropriation account, the final part of the income statement there. Okay, let me take a screenshot again, because there are now two more new students there as well, so that I will actually know the real strength of the class. All right. So now in appropriation account, what do we get now? First, see it. So profit after tax, we actually okay, first of all, I let me tell you what do we get from here. From trading account we get gross profit, right? From profit and loss account we get net profit, or the profit for the year. And from appropriation account we get retained profit. And retained profit, I hope that you know about it. What is it? So let me ask someone who can explain me what is actually retained profit, so that I can continue further. um, so I want to ask someone uh, like Aliza Yasin Malik. Aliza, can you tell me what is retained profit? Retained profit, huh? Because we have discussed it earlier in the finance chapter as well. Aliza Yasin, are you there? Okay, if you are not, if you do not know the answer, you can at least tell me that I don't know, so that I can move on. All right. So I guess that either she is not there, or she's away. She's having a problem with the mic or something. All right. So let me ask Momina Ali. Momina, you always give the answer. So please tell me what is retained profit? Yes, Momina, please go ahead. Momina, yes. You didn't say, yeah. Please go ahead, Momina.
Sir, actually do not remember.
All right. Okay. No problem. No problem. At least you spoke now. Okay. All right. So let me. Hamza Amin, can you explain that? Hamza Amin, what is retained
Yes,
profit?
sir.
What
So
is
it is
it?
a profit after tax and dividends that is reinvested into the business.
Very good, Hamza Amin. Great answer. Retained profit, as the name suggests, retain means to keep it. So retained profit is the profit which is kept by the business itself, right? Because and generally it happens in limited companies, na? You know that in limited companies, owners, that is shareholders, and the business, they are separate from each other, right? And that is why we call it, it's an incorporated business. There is a separate legal entity, yeah. So that's why the business keeps a certain amount of profit with itself. And for that, what do they do? They subtract, as Hamza Amin said, subtract dividends from it, because when, as soon as you earn profit, that is net profit or profit for the year, you have to give a certain share of the profit to the shareholders, and that is what we call dividend. The word dividend comes from the word divide, na, dividend. So you divide the profit and you give the due share of profit to its shareholders. Obviously you have to make them happy as well. And so, but that will be a certain portion. The rest, and then, okay, but before paying it, you have to pay taxes as well. Okay, so you pay taxes as well along with the dividend, and then whatever amount which is left, that becomes the retained profit. Now let's see profit after tax. So you first pay tax, profit before tax, that is the profit for the year. So you calculate, you subtract tax from it. Why it is called corporation tax? Because that is the tax which is paid by the business. before distributing the profit to its shareholders, right? So we get profit after tax, and then this is distributed among the shareholders. Like you can see profit after tax minus dividend. So you subtract dividends from profit after tax, because from that profit you have to uh, um, give the share of profit to the shareholder in the form of dividend. So this is what we call retained profit. So Hamza Amin was absolutely right. Okay, so these are the three sections of the income statement, and finally we get the retained profit. So in the question they may ask you to calculate retained profit. So for that you need to know the sequence. Now let me show you the sequence as well. Now see, now this is the sales turnover or revenue, because now the new name is revenue, right? You subtract cost of sales from it, so you get gross profit. Then you subtract overheads, and overheads I told you this is a fixed cost. Then you get operating profit, and then another fixed cost is there, but we call it interest. Huh? So let's say if you have borrowed money from the bank as well, so you have to subtract that as well. You get profit before tax, right? And this is what we call it net profit, right? So after that, we subtract tax, that is corporation tax. We get profit after tax, and then dividends are paid to the shareholders, and finally, the business keeps the rest of the profit, and that is what we call retained profit. Okay, just a minute. Okay, all right. Then now, now there are different terms which are used in the income statement as well. Let's discuss them as well. Okay, all right. Um, so overheads. Overheads, I explained you. That's why I'm not going to. It is a fixed cost. Huh? So the definition remains the same. It has nothing to do with the level of output produced. Operating profit, again, you need to understand. Now, operating profit means that after subtracting all your operating expenses, whatever profit you get, we call it operating profit. Now, let me get backwards. Like here, you can see operating profit there, right? Because you subtract all expenses from there, but these all expenses are operating expenses. Now, what are operating expenses? Okay, those expenses which are incurred to run the business activity. These all are operating expenses. Like think about salary, depreciation, rent of the building. These all are operating expenses because they are required to run the business, because if they are not there, business activity cannot be run. So we call it operating. To operate whatever amount which is required, um, we call it operating expenses to operate the business activity, right? So interest is actually not part of operating expenses, because this is actually the loan. So you have to pay the interest rate, but this is separate because you have to pay it, and it has nothing to do with the operating expenses, because operating expenses are the expenses which you have to pay on regular basis, daily basis, right? And normally they are revenue expenditure. We discussed that as well, the difference between capital and revenue expenditure. So interest on loan is normally paid after a year. So it is not paid on daily basis. So that's why it is not part of operating expenses. All right. So if we subtract operating expenses only, we get operating profit, right? So tax is there again. You know that amount of money which is actually paid by the business to the government, right? So tax is actually the source of revenue for the government. So this is you know about it. Dividends again, you know that a certain portion of profit, it can be large, it can be small, whatever it is, but the portion of profit or the share of profit or a certain percentage of profit which is distributed among the shareholders or the owners of the business, it is called dividends. And finally, retained profit. So I don't need to talk about it much. You know the how to calculate it. And retained profit, another name given to retained profit is plowed back profit. Plowed back, PLOUGHED, plowed back. Why? Because retained profit is a source of finance. You know that. So later, business can use it for the expansion of the business as well, right? So that's why it is called. It is for reinvestment purpose. The business, if business requires a certain amount of money, they can use the retained profit because it is lying with the business, and it comes after paying taxes and dividends from the net profit of the business. Then uses of income statement, if you see that, can be used to measure the performance of the performance with past year performance and other companies. Yes, this is possible. So again, I told you, remember, performance of the business is normally measured on the basis of profit, right? And profit is shown in the income statement. You know that. You can see the what amount of profit you are getting right now and what amount of profit you are getting, you were getting previously, or you can compare it with your rival businesses as well to see that where do you stand in terms of performance, in terms of profit, right? So this is again an important uh, um, yardstick through which you can measure whether business is going in the right direction or not. Then to provide it to creditors or banks, again, it is important because if you want to borrow money from the bank or you want to buy goods from the creditor on credit without paying cash, so in both cases, what you have to do, you have to show the income statement because that will guarantee that business will be able to pay back the amount or not to the bank or to the creditor. Creditor, you know that, na? I told you earlier. Now the new name for creditor is trade payable, and actually that means that you owe money to those people or to that business, that in the at some future date you have to pay it back because you have bought goods on credit from them. They check the income statement to see the profit of the levels of the business and to see whether they will be able to pay it back in the future or not. So otherwise you will find it difficult to get the goods on credit and to borrow money from the bank as well. Now, useful for prospective investors. Okay, those investors who actually are your potential customers, and there is every possibility that they may invest in your business. They would like to see your income statement. Again, why? It's not only for the purpose that how much return they will get. Yes, it is important as well that by looking at the profit figure through the income statement, they will see that okay, the business is earning a reasonable amount of profit, and they may get a good return on their investment. That is what we call dividend, right? So yes, and they can feel confident that yes, this is the right business to invest, right? The other thing is they want to see that whether their investment is actually safe there or not, because if they see the income statement and they say profit is actually very low, or in fact they are going low year by year or month by month or whatever in a certain time period, so they might not invest there because they may feel that a business starts suffering loss. So obviously there will be no profit, but their investment will be at stake as well if in the future a business closes down. So they can see the year by year performance of the business by looking at the past figures of the income statement of the previous year as well and the current year as well. So it is important for them to, in order to attract investors, you need to have the income statement as a business. All right, now comes balance sheet, or another name given to it is statement of financial position, right? We call it. And I told you earlier, what do we actually obtain from it? We actually see the financial strength of the business. Why? Because we here compare the assets with the liabilities of the business. Assets are the items which are owned by the business, and they actually the higher the assets a business has, the better will be the financial strength of the business or the liquidity of the business as well. Now, liquidity means ability of the business to pay expenses or to convert their assets into cash. I'll talk about liquidity as well later. And then we have liabilities, items which are owed by the business. Business has to pay it back, right? And assets are used to pay liabilities as well. We'll talk about it now. It shows estimated value of the company at one moment in time at the end of the financial year. I have written at one moment in time because statement of financial position shows the total value of the assets of the business, total value of the liabilities of the business, but at a certain date. Like if I say 31st December 2020. So the balance sheet will only show the value of the assets and liabilities on that particular day. After that day or before that day, nothing is shown in the balance sheet. Huh? So that is why I've written at one moment in time at the end of the financial year, right? Now, so items of balance sheet, what are the items which are part of it? One is fixed assets. So another name now, the new term which is used for it, that is non-current assets. Remember, and non-current assets. Now we need to understand that as well. That let me use the yeah this one so that I will keep on explaining you that as well. Now, if I write here, so we call it non-current assets, right? So, and they are also called fixed assets, right? So, non-current assets are all those assets which are kept by the business for more than 1 year. Now, why they are kept by the business for more than 1 year? Because the purpose is not to sell it. The purpose is to use those assets to produce goods and services, right? So that is why obviously they'll be kept by the business for even more than 1 year, but At least they should be kept by the business for more than 1 year. And one more thing, they are not easily converted into cash. Now, they cannot be converted into cash that easily. Now, let me give you an example. In fact, I'll ask you rather to give me an example. Faria Khan, give me an example of a non-current asset. Yes, Faria, can you give me an example?
Sir, buildings.
All right, very good. That's right. Okay, anyone else who can let me, Mohammed Bilal, can you give me an example of a non-current asset? Any idea?
Land. Plant and equipment.
All right, very good. That's right. So you already know about it. That's great. So yes, building is there, land is there, even equipment or machinery is there. Yes, that's great. Now you can see that these are the items which obviously will be kept by the business for more than 1 year because they are not for the selling purpose. They are for the purpose of
Sir, do these include investment in other companies also?
investment, like in the form of cash. No, like let's say you invest money in the form of cash. That is not your non-current asset. Reason is because cash doesn't stay in the business for more than 1 year. Remember, because sooner or later it is going to be used either to pay your daily expenses or to buy something. So that's why it doesn't come under non-current assets. So now imagine building land and equipment. They are used in the production process. They are not for selling purpose, right? That's why they stay there with the business for more than 1 year, right? Secondly, they take time to be converted into cash. For example, you want to sell building, so for that you have to advertise, you have to find a customer who can buy the building at the price you actually quote. So it will take time. Same is the case with land, same is the case with equipment as well. So that's why they take more time to be converted into cash. If you require cash immediately, this is not the right source through which you can get cash immediately. So this is actually the way we define it. All right. So then we move on to next one. That is, what is it? Let's see. That is current assets. Again, now let me define that as well. But in fact, I won't define it because it's actually exactly opposite of it. Current assets. Okay. So these are all those assets which are kept by the business for less than 1 year. So I will just write here kept for less than a year, right? Okay. And one more thing, and that is that easily converted into cash, easily converted into cash, right? So these are, so this is exactly opposite of it. And if I talk about the example of it, so example again can be given. So who can give it to me? uh, Sufyan.
Accounts receivables.
All right, great. Yes, that's right. Accounts receivable. Again, it is the debtors. Accounts receivables. Okay, so another name given to it is debtors as well. Yeah, those who study accounting, they know about it, but I'll write the word in brackets as well so that non-accounting students may also come to know about it. The debtors. Okay, debtors are the people from whom you have to collect money. Like, for example, you have sold goods to some people on credit, and now you have to get the money back at some future date. So you will actually keep them. You will write that figure under the caption debtors or accounts receivables or trade receivables. Huh? That this is your asset, and you will actually get cash immediately after few months, maybe a 1 month, depending on how much credit period you have given, like 1 month, 2 months, 3 months, कितने महीनों के बाद आपने लेना है, but obviously you will get it soon. That is why you can easily convert them into cash because after a month you will get it, or even if you offer a cash discount to the debtors, like for example they are supposed to pay after 2 months, okay, the amount of money for which equal to the value of the goods they actually bought, right? So what do? You offer them a cash discount. You say, all right, if you pay in a month, within a month, because you are supposed to pay after 2 months, but if you pay within 1 month, you have to pay less amount of money, like 2% discount will be offered. This is how you can convert debtors into cash quickly. That is why it is part of current asset. Okay, others could be like there is cash in hand as well, there is cash at bank as well. Now, okay, and there is inventory as well, right? So now you can say, sir, why you are writing cash in hand and cash in bank? Because they are already in the form of cash. Yes, they are. So that is why they are current assets. So we can say they can be converted into cash quickly. In fact, they are in the form of ready cash. Na? So they are current assets. They are called current assets. Na? And they are not kept by the business for more than a year. They are sooner or later going to be used by the business. Inventory again, it's the stock which is there. Either the stock is in the form of raw material or it is in the form of work in progress, half done items or finished goods. Sooner or later, they will not be there in your warehouse because either you will sell it or you will use it in the production process, right? That's why inventory is also not there in the form in the warehouse, right? And yes, if you want to sell it, you can sell it as well. Like you have raw material and you think that you are not going to use it in the future, so you can sell the inventory in the market and you can get cash there as well. But I'm telling you, inventory is actually that sort of a current asset which yes can be converted into cash quickly, and it is a current asset, but it is actually slower than other current assets, right? If I talk about debtors or cash in hand or cash at bank, so they are actually slower than them. Yes, they can be converted into cash quicker than the non-current assets, but they are slower than the other current assets. So that is why it is called current assets, but they are not actually another name. I'm going to use it liquid assets. Okay, do remember liquid assets. Liquid assets are also they are current assets. Remember, they are current assets, but they can be converted into cash even more quickly than current assets. That is why we call it liquid assets. Huh? So cash in hand, cash at bank, debtors, they are all liquid assets. The inventory is not a liquid asset. Huh? Why? Because it takes some time to be converted into cash. Because again, you need to sell it and to find a right price and place uh, uh, to get the money. Right? Okay. Now getting back to the slide again. Again, we are discussing the contents of the statement of financial position. That is the balance sheet. So now current liabilities again, and then we'll talk about the long-term liabilities as well. Again, now there is a new name there for it as well. Let me use it there here. So I will talk about now current liabilities, right? So, but what is it? Items owed. Now I'm writing owed. It means you have to pay it, na? Items owed by the business within 1 year. Okay, you have to pay it back within 1 year. And the examples could be again as जिस तरह trade receivables होते हैं, account receivable होते हैं, इस तरह trade payables भी होते हैं ना. Trade payables means that you have bought goods on credit and now you have to pay cash in the future. So you will use trade payable there, that you have to pay that amount to the concerned party, person or individual, right? So you'll call it trade payable, payables and payable. And another name, the old name was the creditors, huh? That the people you have to pay the money back in the future. So and obviously you have to pay it back within 1 year. In fact, in a few months or after a month, you have to pay it back. Huh? So similarly, there is another term you are familiar with it because we did study the chapter financing business activity, business finance, right? So overdraft again, it is a current liability because when you avail that facility, so obviously you have to pay it back after some time. Like this is, that a short-term source of finance. Huh? So in fact, overdraft is cannot be given for more than a year. In fact, so you have to pay it back after using it. You have to pay it back after even for a month or maybe after a couple of weeks as well. Huh? So depending on upon the need of the finance. This is also part of current liabilities. Similarly, another name, long-term liability is there, and for long-term liability, the new name is non-current liability, right? Non-current liabilities, and again, it is the opposite of current liability. That is, items owed by the business, fine, but paid after 1 year, right? You have to pay it after 1 year, non-current liabilities. And the examples could be one is like let's say long-term bank loan, and this is normally paid after 10 years, right? So similarly, if I talk about debentures, again it is a kind of a loan which you actually borrow from the people. People become debenture holders and you get the money from them. So debentures, they are also paid after 10 years by the business. So this is how. Okay, all right. So these are the examples of non-current liabilities. Now moving backwards to the slide, the contents of the balance sheet. Now fixed assets, that is non-current assets, current assets, then current liability, we have covered it. Then long-term liability, that is non-current liability. And share capital, again you understand share capital is share capital because as a company, limited company, you raise capital. One of the sources by issuing shares. Huh? Again, we studied that as well. When you issue shares, you get a certain amount of money. That is what we call capital. So we name it share capital. The amount which is raised by issuing shares is called share capital. Again, you understand this as well. Reserves, again, reserves is actually a caption which is used in which retained profit is kept. Okay, current year's retained profit and previous year's retained profit is is kept under this caption reserves. Now, why? Because you might need it in the future. For example, if in one year there is some retained profit, but business is not going to use it because there is no need to use it. So business will keep it in reserves. Okay, and there might be some retained profit of the previous years as well. And then whenever business needs it, business can use them there as well. But this is actually there in the one of the item of the balance sheet or the statement of financial position. All right, now just have a look of the statement of financial position. Fixed assets, non-current assets. Okay, so you add current assets in it. You get what do you get? You get total assets, right? Now, fixed assets plus current assets, you get total assets. All the items which are owned by the business. So if you subtract current liabilities, you get net assets employed. Now, net assets employed means the total assets which are in use, right? And why we are calling it net? Because you have to pay first current liabilities at the end of the year. So after paying it, you see what amount is left with you in the form of assets. Because assets, you know that they are actually the financial strength of the business and they are later used to support business activity. So if you now minus creditors falling due after 1 year. So now this is another name which is used for long-term liabilities or non-current liabilities, and that is we can call it creditors as well. Although if you see that I have used this word creditors there in current liabilities, right? See, creditors, I have used it. So now you might be confused that why, sir, it is there in non-current liability as well. Why? Because now they are using a different term. And what is that term? They are saying creditors falling due after 1 year. So automatically, because if it is they are paid after 1 year, so they become non-current liability or long-term liability by definition because they'll be paid after a year. Okay, now so if you subtract this as well, so then you actually got the final value of the business. Like there are total assets, there's fixed assets, current assets. You subtract current liabilities, you get net assets employed, and then you subtract the non-current liability as well. So you will get the total value of the business, that how much value business has after paying all their liabilities. And this actually shows. That's why I'm saying that this actually shows the financial strength of the business. That whether business has the capacity or business does have enough current assets to pay its current liabilities and non-current liabilities, and what amount is left afterwards. So that actually shows the net worth of the business, and higher that value is, the better will be the financial position of the business. Now share capital, again, if we share capital you understand, reserves you understand. So we if we add them together, we should get this amount. Why? Because obviously the assets you buy, this actually comes from these two sources, either share capital or reserves, right? These are the sources of finances available to the business. So you use this to buy assets there as well. So both should be equal there as well. All right. Okay. Now uh, talking about some other concepts there as well. Okay. So there is all right. I think time is not actually allowing us to uh, continue further. So still, the last slide is there. I think I'll cover it maybe in the next class after winter vacations. I think that would be better. And then maybe a very small section which is left, that is accounting ratios, and we'll talk about it in that class, and because that requires calculations. So I might require face to face or maybe some time to explain to you. Okay. So any question regarding whatever we discussed? So So you are more than welcome. So there is no question, right? All right. So thank you very much. That's all. I'll see you in the next class.
मुझे तो the socks.
हाथ पैर के डिब्बा पंच में मेरे हाथ चले गरम नहीं रोज उनके से